My name is Mark O'Brien. I am an attorney at Copenbarger. I mainly work in the estate administration department. Like I said, that covers a lot of trust administrations, probate administrations, conservatorships, guardianships, fiduciary accountings. I do a little bit of trust and probate litigation as well. And I also do a little bit of estate planning, although not too much at this firm. At my prior firms, I did a lot more estate planning, tax planning, business succession planning, and wealth transfer planning. So kind of the gambit of all the areas that Copenbarger covers in their practice areas. So that's a little bit about me. Married, have a son who's now 2 years old. So going through the awesome part of him now being able to speak and really enjoying him, but also going through the terrible twos. So that's been fun waking up to him screaming at 4 a.m. Again, this is just for educational purposes. Please, this is not going to be considered legal, accounting, or tax advice. It's just general guidance, just information to be provided to our clients to give them a better understanding of the topic matter that we'll be discussing today, which is Proposition 19. This case, even more so, this law is extremely unique to everyone's particular circumstances. So again, this is general information. If I use examples, please do not use your personal experience and pollinate that with the examples that I'm using. They are purely just illustrative purposes. Please reach out to us. Please schedule a meeting if we can dive deep into your particular case. As probably most of you are aware, here are a lot of the attorneys. We do have some new faces. I'm sure you're familiar with Lloyd and Larry and Victoria, and a lot of you probably are familiar with Mark Krause by now in estate planning. Catherine has been with us for a period of time as well in business and tax, but we also have Kevin Vandenbroek, who does business, tax, and advanced planning. We also have, you'll see at the bottom, you may be familiar with James, myself, and potentially Megan as well. But we also have Greg and Matt, who are awesome additions to our administration department. And as always, of course, we have Elaine Alston, who's our estate litigator. This is a nice picture of the attorneys and all these support staff. So the paralegals, our marketing, accounting, billing, you name it. And then, of course, our standard locations. South Coast Metro here in Orange County, San Jose, Temecula, Santa Cruz, Pasadena, San Diego, Sacramento, and Laguna Hills. If you are not familiar with me, I'm located out of our South Coast Metro, our main office here in sunny Orange County. Okay, now let's dive right in. Today's agenda. Essentially, we'll be talking about Proposition 19. So I'm sure a fair amount of you have heard of this proposition one way or another, but all of us voted for it, whether you knew you voted for it or you didn't know you voted for it. And I'll kind of go into the psychology and what happened a couple of years ago back in 2021. But again, today's about Proposition 19. Now, Prop 19 covers a vast variety of law. We are going to be hyper-focusing on its effect on real estate transfers to your family members, to your heirs, to your beneficiaries through the means of a probate or even more so through the means of a trust administration. Okay, that's going to be the focus. And again, Prop 19 covers, like I said, a lot of different areas of law, but we're going to be talking about the parent-child transfer, or potentially, if you don't have any children, you've left it to somebody else. How does Prop 19 affect real estate transfers within the family? Okay, and the main other aspects underlying Prop 19: timing decisions, family decisions, trustee roles, and property economics. And we're going to go through each one of those subtopics and flesh them out in much greater detail. In this one, you may see that a slide may come up and you'll be looking at that, and I may jump back and forth. I may go ahead with what I'm talking about because it's relevant. So please forgive if it's a little bit discombobulated just because there's so much information. And as I'm going through it, I may start talking about the next slide, even though it's a couple down. Okay, Proposition 19, what changed? Prop 19 made numerous changes to California law. One of those changes negatively affected children's ability to maintain their parents' extremely low property tax base. And the next slide here will kind of give you a little bit of understanding. So prior to 2021, we had what was called Prop 58. And you'll see here at the bottom of the slide, Prop 58 was fantastic. And Prop 58 has been around for a couple of decades. I believe it was initiated in the 90s, or even potentially prior to that. But nonetheless, for about a few decades, at least while it was relevant to me and I was working in the legal community in the 2000s and 2010s and now in the 2020s, Prop 58 was fantastic. And you can see here kind of the below reasons why it was so amazing. To give you a backstory, I'm going to spend some time on this slide because it'll give you a nice preface and understanding of the California laws that cover this. So when anyone owns real estate in California and they pass away, by law, whoever it is, whether it's a personal representative, an executor, an administrator, a trustee, has to provide notice to the county assessor's office. And they have to, technically, they have to do this within 150 days of the death. Now, there's no true enforcement of that. So a lot of times that document is filed 180 days, a year, 9 months, 10 months, whatever the case is, but it's still required. And the reason is the assessor always wants to reassess the property for property tax purposes. Okay. And I'll give you an example. So if I buy a home for $100,000, okay, that's my property tax base. I'm going to pay my property taxes based on that amount, usually on average about 1%. So in that instance, I would pay $1,000 a year. That goes to my property taxes. Okay. Now 40 years goes by and I bought the property in 1980. It's now 2020. And my property is now worth $1 million. I'm not paying property taxes based on that current value. I'm paying it on that $100,000 purchase price plus the incremental small increases every year that the state of California can increase. But Prop 13 limits that. They can only increase it up to about 2% per year. So over those 40 years, my property taxes have increased negligibly. So I'm only paying, even though my property is worth $1 million in 2020, I'm only paying like $2,000 a year. Okay. But when I pass away and that property goes to whoever I designate as my beneficiaries or heirs, the county assessor wants to jump up the property taxes and they want to use that current, let's say I pass away in 2020, they want to use the current fair market value so that whoever gets my property is no longer able to keep that same low property tax base, right? So they get to jump it to using $1 million property tax base, and that would mean my heirs are probably going to pay $9, $10, $11,000 a year, and that's going to generate a lot of additional revenue for the county. And then you multiply that by everyone who's passing away with real estate, and you multiply that by the numerous counties that we have in California, and that's a ton of revenue that's generated. Okay, so that's kind of the stance that the assessor takes. But what Prop 58 did was it said that if I have a principal residence and that principal residence goes to a child, one of my children, or multiple of my children, they could keep the same property tax base. And what was even more astonishing was there was no cap on value. So as a lot of you are probably familiar with, if you purchased property on the West Coast in Malibu or Santa Monica, or you purchased property in Newport or Laguna back in the 50s, 60s, 70s, and you paid $50,000, and all of a sudden in 2020 that property is worth $5 million, right? You could transfer that as long as it was your primary residence when you passed away to your children, and they could keep the same property tax base. So if I had a $50,000 property tax base and I was paying $500 a year, and it's now 2020 and it's now a $5 million property, I could transfer that to my son and he could keep paying the $500 property tax base, even though it's a $5 million property, which was fantastic. In addition to that, they did not have to live in that home. They could use that home as a rental. They could turn around and rent it out, could still keep the same property tax base, meaning they could have a lot of additional income that they get to keep because it's not going to the county assessor of the state of California. On top of that, this is why Prop 58 was so great, was you had additional $1 million of assessed value. So what that means is I could transfer my primary residence, regardless of the value, and an additional $1 million of assessed value. So I could potentially protect a vacation home, a second or third home. Maybe I had an investment property or 2 investment or 3 investment properties, depending on where they are in California. And I could keep all of the same property tax base for all of those, or at least portions of them, depending on how big my real estate portfolio is. And my heirs, my children, right, as long as they were children, would keep the same property tax base. Okay. So that's kind of the background to Prop 58 and what it was prior to 2021 when the law changed. So February 15th, 2021, Prop 19 came into effect. So February 16th of 2021 and onward, we are now in a Prop 19 world. And as you can see on the top of this, some very big changes. Okay. One of them is that now I cannot convert my children, and I'll use my son, right? Let's say I pass away, my primary residence goes to my son, right? Everything goes to him, including my residence. He must move in to that home and claim it as his own primary residence. He cannot rent it out, right? Can't use it as an investment property, can't use it for any other purpose other than for his own primary residence. So that limits, quite a bit of functionality there because you can't turn it into investment property. The second you turn it into investment property, it'll be reassessed, and now he has to pay higher property taxes, and that flows through to the tenants, meaning you're going to have to raise the monthly rental rate to account for that additional expense. Also, if he has his own home, right, he has 1 year to figure this out from the date of death. Okay, so now he has to figure, okay, does he need to sell his home? What is he going to do with that property? Where is he living? Is he living in San Jose? But my primary residence was in Orange County. He has to pick up his family and his life and now move down here. Or if you're living out of state, right, you can see there's a lot of complications with that. You'll see here, all other non-residence property is reassessed. So just from default, understand that any other property that was not my primary residence, my second home, my vacation home, my investment properties, they are all getting reassessed. And lastly, for that primary residence, there's a cap on it now, right? In my initial example, I used a $50,000 Malibu home that's now worth $5 million. There was no cap under Prop 58. Now there's a cap, and it's $1 million cap plus the current tax base. Okay. So if my current, like I said, if I bought a home for 100,000, that's my current tax base. If when I die, it's worth $1 million, you add those two numbers together, right? So it's $100,000 tax base plus the $1 million. That means I can protect up to 1.1 million of assessment for property tax purposes. So if my property is worth $1 million at my time of death, not a problem, right? 100% is protected, provided that my son moves in within that year, right, and satisfies all those other elements. However, right, the average home value in California is currently, I believe, between 7 and 800,000. Okay, and that's statewide, right? But if you go into Northern California or Southern California, it is not 7 or 800,000. The probably average home value is probably between 1 and 1.2. Okay, so there are a lot of people that are affected by this because they're not getting full protection. Same scenario. If my home's worth 1.5 million at the time of my death, but my property tax base is only 100,000, again, I can only protect 1.1 million. And if the assessor values my home at 1.5, that's a $400,000 difference, meaning that my property is going to get partially reassessed for that difference. Now, my son will still benefit because he doesn't have to pay property taxes at a $1.5 million clip, but he will have to go from 100,000 to 500, which means he'll go from about $1,000 payment to about a 5,000. Okay. And again, these are all conversations that you'll be having with your kids if you end up passing your property to children, having the conversation with the estate planning attorney about what tools we can use while you are still living and breathing and have the ability to control this. Okay. And that's kind of where we talk about, as you can see, Prop 19 was quite a burden. I don't, a lot of us who work in this industry believe that the population in California did not know what they were voting for. And the legislature of California was very clever in hiding some of these ramifications within the other changes. And not to say that Prop 19 is completely bad. There are actually some aspects of Prop 19 that are beneficial. I'm going to put those aside for today because they are not really relevant to our conversation. But again, just wanted to give you really a nice foundational understanding of the prior law and how it changed to the current. And now that you know the current, you know why it's a burden, right? It's a burden, not necessarily on you or I, but it's going to be a burden on your family members when they are administering the trust. And we're going to kind of go through, again, what those burdens are and how we're going to turn that burden into a blessing. Okay, like we said, Prop 19 applies only to primary residences. As we stated, non-primary residences are not protected. Your vacation homes, your investment properties, your second homes, those will be reassessed. So if you own multiple pieces of real estate, it's good to have the discussion with your attorney, excuse me, with your attorney, with your CPA, with your financial advisor, and to the extent feasible, and this will be very caveat, very case by case, depending on your family and your family dynamics, having the conversations with your children, right? Explaining, having them involved and kind of giving them a heads up of like, okay, I got 3 investment properties over here. They're all going to be reassessed. You and your brother or sister, whoever it is, may need to sell these properties, or you're going to need to understand that the profit margin is going to be reduced, or you're going to have to find a way to increase um, the monthly rent, and so on and so forth, right? That way it's not so much of an impact and they're not blindsided by it ultimately when you pass away and they are dealing with your estate administration. Um, okay, kind of some of these comments that I discussed already. Reassessment can significantly increase property taxes. Absolutely. If you live in Southern California, if you live in Orange County, you could have a home that's worth 2, 3, or $4 million, even potentially 5, 6, 7. Right? That's becoming less. It's becoming more and more common to have a multi-million-dollar home in Orange County. And like I said, if you purchased it for a couple 100,000, it's now worth 3 million. Who cares about that $1 million protection, right? If you're going from $200,000 tax base to a $3 million tax base, and you're only protecting, 1.2 million or 1.3 million, you're going to get reassessed, and your family is going to have to pay $25,000 of property taxes a year. So even with utilizing Prop 19, it still may not be feasible. So having that discussion, being aware of that is prudent, and it also even though it's a bad thing, it provides peace of mind because expectations can be hampered rather than someone thinking, oh, I'm going to inherit my, parents' $4 million property and it's going to be all nice and dandy. And then all of a sudden you're hit with this $40,000 a year tax bill. I guess same thing, higher taxes affect affordability, right? What you were able to afford, your child or children may not be. So that increase in property taxes can be very detrimental and basically negate their ability to maintain that family home. And it could be a family home that you've had for generations and that the desire and want was to keep that property, but your kids may not be able to. They may be financially forced into selling that because of those changes. Okay. Now, advanced planning may change those outcomes. And I'll kind of go through some of those. And when I say advanced planning, I mean two different things. Advance planning with no D, right? Planning in advance and understanding your options, and also advanced with a D planning. Okay. Meaning higher level planning that requires a little bit more experience, education, background by the attorney. Okay. LLCs can be used, very useful for investment properties, and that is what we would call one of the tools of advanced planning. So if you have second homes, investment properties, that's something to reach out and have a discussion with us. Although I will say this, having implemented a lot of this type of advanced planning at prior firms, if you already own these second homes and investment properties, the LLCs will not be useful. Okay. The key component here is that the LLC must be formed before you acquire the property. So for anyone listening to this, if you plan on buying a second home, plan on buying a vacation home, or plan on buying investment properties, please contact one of our estate planning attorneys. Also contact our business department because we can help you set up the LLC because, excuse me, the LLC has to purchase that property. And I won't go into explicit detail on the reasons why, but essentially it needs to be the original transferor. And if you do that, and the LLC is the one that acquires the property, there are a whole bunch of planning techniques that we can use to negate Prop 19. Because the LLC is the one who purchased the property, it falls under different laws. And not only that, you may not even have to report to the county assessor. You may only have to report to the state of California Board of Equalization. Again, I'll defer that because it's too in-depth for this conversation. But if you are thinking about buying additional properties or investment properties, or if you have an investment property and it's in your name or the trust name itself, and it's too late to do an LLC, but you're thinking about doing a 1031 exchange, meaning you're going to sell your investment property or potentially buy and roll that into a new investment property. There may be some planning techniques that would be useful. I'm going to keep harping on this. And as you see, as I go through this, that's why I'm not really able to answer any specific questions, because there's so many details, so many variables that will have to be discussed and fleshed out. It's worth having the discussion with us. Ultimately, you can have peace of mind, sit down and go, okay, what are my options? What are the full gambit of options? Which ones are actually feasible for my situation? And then looking at the numbers and looking at the values, looking at the people that are, looking at the players and the interested parties. Even if it's something that's viable, maybe it's not worth it, right? Maybe it's not worth the legal fees, the taxes, or the planning to negate whatever the tax implication may be to your child, right? So it's good to have that, because at least you could flesh it out and you have the control. It's within your domain, and you're not letting California law tell you what to do. You're the one who has the autonomy to make that choice. Okay. And the last moment here, the last item you'll see, it's the most important. Planning must occur before the transfer. And that's, for a primary residence, right? You want to do the planning before, and I'll kind of go through that. And for non-primary residences, you want to do the planning before. Okay. Timing decisions and I'll say short-term and long-term impacts of those. Early time decisions, early choices. Okay. Planning before the crisis matters. And I'm not a huge fan of that word crisis here. I don't think it's necessarily a crisis, but it's planning before you're stuck, right? It's not a crisis. It's just stuck in that you don't have the options. Your children don't have the flexibility, and they're forced into some more difficult choices that they maybe didn't want to make, or that maybe you as the parent and the owner of those properties didn't want them to have to make. Okay. So tools were, some of these things are pretty logical, straightforward. The tools work best when planned early. Revocable living trust updates, right of first refusal, and I'll go into that in much greater detail, LLC or entity formation, lifetime gifting strategies, exit strategy planning, irrevocable and charitable trust planning, and then the filing timing affects outcomes of that right of first refusal, trust loans, selling the property. So I'm going to kind of go into a couple of these, and you'll see on the later slides, I'll flesh them out. So revocable living trust updates and the right of first refusal. So a right of first refusal is one of the most important tools that we can use for a plethora of reasons, but I'm going to highlight a couple of them in this session today. So that right of first refusal. So there is, and I'm going to give you an example. Even if you don't do any planning, right? Let's say you have a primary residence, it's your main asset that you leave as your legacy to your children. And again, remember, Prop 19, the only way to qualify this is if it's a parent-child transfer. So none of this is going to work if it's a parent to sibling, right? I don't have any children, I'm leaving to my siblings or to my own parents. Or actually, sorry, if I leave it to my parents, it will also work. So either way, if it's child to parent, parent to child, it will work. But if it's going to a sibling, cousins, nephews, friends, family members, other non-blood, a sister-in-law or a cousin twice removed, it's going to get reassessed. No ability, okay? But for a parent to child or child to parent, we can utilize this planning. So I'm going to give you an example, okay? Let's say I have $1 million home, and it's the only asset that I have. When I pass away, I have my home, I paid it off. I have my pension is ceasing, but no life insurance, very minimal cash, a couple $1,000s, let's say, no investments. Okay. Pretty straightforward, modest estate. Okay. And I have 2 children. Okay. When I pass away, the issue becomes that, yes, it's both going to a child. Okay. But let's say that one of my children, right? Let's say I have a son and a daughter. Let's say my son doesn't want the real estate. He wants cash, right? And my daughter wants to keep the real estate, right? No problem. People would say, okay, we have to do a buyout. Okay. And you'll hear the term, or maybe you've heard the term, yeah, I'll just buy out my sibling. Okay. And that's a problem. That's a big problem for the assessor's purview. Okay. The reason being is, in my example, right? I need to get $500,000 of cash to my son and I need to get the house to my daughter. So she goes and gets a $500,000 loan to pay off my brother. Okay. When she does that, the assessor treats that as a sibling to sibling transfer. And that is not a parent to child transfer. So they reassess that 500,000. So she only gets that protection for half of it. So they just so even though they qualify for Prop 19, half of it got reassessed because of poor planning, right? Or because of the lack of other assets. Okay. So that's a big issue. And the problem is the only way around that, and there's another tool, and you'll see why I said trust loan, is that the trust can get a loan at the trust level and inject cash. But the problem is you got to go find a bank that's willing to loan to a now irrevocable trust, which is difficult. One, two, they're going to look at the trustee's personal finances as well for additional guarantees on that loan. So if you are not in a strong financial position, and whether that's you have a lot of debt or whether you have a poor credit score, whatever the case may, or you don't have a lot of personal assets to use as collateral, right? That may be difficult, and you may not be able to get that trust loan. And it becomes a complicated strategy. Doable, yes, but complicated, because once you get that trust loan, my daughter has to go get a personal loan to immediately pay off that trust loan. So there's a lot involved. There's a lot of financing fees. Interest rates may not be favorable. The lender may not want to lend to their irrevocable trust at all. So you may have to go find more creative financing solutions. And anytime you hear the term creative financial solutions, just know that that means higher interest rate, higher loan origination fees, less reputable lenders, right? So you can see how this is the tentacles of this is going out quite a bit. And ultimately, my daughter and my son may go, you know what, this is way too complex, way too expensive. I don't think this can even happen. And they got a 1-year deadline to do this. So they may go, you know what, my daughter who really wanted to keep the home, she had been residing in it already, but she doesn't have the income to support any type of reassessment. Even if it's only 50%, she can't support it. They're now selling the property and splitting the proceeds. To avoid that, you can add what's called a right of first refusal to the trust. And that right of first refusal says, I am naming, in this instance, I can put in my trust, I'm giving my daughter the right of first refusal to buy the property from the trust. And in that instance, she does not have to, we don't have to get a trust loan. We don't have to do any of that. She just has to get a loan from anywhere to basically buy off the other half of the portion that my son would get, and place those funds into the trust account. Right? And if you do it appropriately, the assessor will not see that as a sibling to sibling transfer. So one, she gets to protect 100%. She gets to stay in the property. And two, you don't have to get a loan at the trust level and a personal loan. So that saves a whole bunch of time, expense, and grief. And three, she can get financing from pretty much anyone. I usually advise don't get the financing from your spouse, but anyone in the family. So if you're able to get a family loan, a lot of times you can use lower interest rates. But even that being said, it's a smaller loan, one loan, easier to obtain, easier to accomplish, much quicker timeline. And my son is probably happier because all of this is happening faster, cheaper, smoother, which means he's going to get his funds quicker, right, in his pocket, which actually a lot of times may save the relationship between the two of them. Especially if I have put in the trust, I'm giving this right of first refusal to my daughter. If she exercises it, here are the terms. If she doesn't, then it goes, 50-50 to the both of them. And I'm then taking the next step and I'm articulating that to them. Now, talk with your attorney about divulging your estate plan particulars during your lifetime. You may have a circumstance where you don't want to convey that to your family members or your children while you're living because it may cause additional problems. Of course, there are a lot of times when that is the case. But if that isn't the case and everyone gets along and everyone is mature and financially stable, having that conversation gives them a lot of clarity. And when they come meet with an estate administration attorney, they'll have a lot of that fleshed out, which also means save on time, save on expense, save on clarity, and it expedites the process. Administrations can take on average 9, 12, 15 months easily. And if you're having to deal with a 1-year deadline to keep this property, that could be delaying the rest of the administration. So right of first refusal and updating your trust, discussing that. Very, very, very useful tool. Um, and like I said, quite beneficial to all members, even in my example, my son who isn't getting the property, beneficial to him because he has clarity. He has peace of mind. The document specifically says we gave my daughter the right of first refusal, right? There's no ambiguity, there's no vagueness, right? And sometimes just knowing that it's clear, even if it doesn't necessarily benefit him, also helps him move forward, helps him with grieving, helps him keep his relationship with his sister after I am gone, and so on. Okay. Kind of moving along, LLC or entity formation. Like I said, very useful for non-primary residences, but again, must be formed before you acquire that property. So please reach out if you are planning on acquiring property, especially investment property and even commercial property. Please contact our estate planning department to talk about updating the trust and talk and schedule a meeting with our business department to discuss potential formation of the LLC, not only for asset and creditor protection for the property itself, right? I would suggest you do an LLC no matter what, not just for property tax purposes, but for asset creditor protection and other tax deduction protection and strategies, but also for property tax reassessment. Okay. And along with that LLC formation, there are lifetime gifting strategies that can be used. I won't go into that, a little too complex for this purpose. Same thing with exit strategy planning. If you have a bunch of investment properties that were properly acquired, there are ways to plan for that exit or for the transfer, the generational wealth transfer planning that goes along with this Prop 19. Okay. So you can see there's a lot of planning that can be done, but you have to do it before. Okay. We can negate a lot of these problems, or at a very minimum, flesh all of the available tools out, talk to you about them, and maybe you come to a conclusion it's not for you or it's not appropriate or it's not necessary, but you have the peace of mind knowing that you did all that you could to kind of negate some of these unfavorable laws. Okay. But before I move on here, I want to touch briefly on just the title of this webinar. It's turning a blessing into a burden. I mean, a burden, other way around, a burden into a blessing. And the reason, as you can see, there's a lot of burdens that are involved in Prop 19, and there's a lot of burdens involved in just administering a loved one's affairs when they've passed away. But with proper planning, transparency, utilizing the tools available to us, a lot of that can be mitigated. And I think that's very important because if you take this opportunity, if you take this burden of an opportunity, you can turn it into a blessing because you've now updated your plan, you've solidified it, you made it more concrete, you brought it current, you've been transparent, you've been clear, the instructions are beneficial, the tools are going to be utilized, and a lot of that's going to save a lot of heartache. A lot of it's going to, everyone grieves differently. If any of you have gone through my prior webinars, everyone grieves differently and everyone handles the loss of a loved one in different manners, some positive, some negative. So allowing that person to focus more on the grief and on the grieving process and on moving on with their life and honoring and cherishing their loved ones, this helps. This definitely helps. I can't tell you how many times it has cleared up ambiguities and allowed people to move forward with a greater understanding and better protection. Better protection to the family, better protection to the trust, and less money going to the attorneys, and infinitely more, less money going to the state of California, right? We're keeping the funds in the family pocket rather than paying additional taxes, okay? Kind of moving along here. Timing shapes future options, right? Rights of refusal affect early decisions. So like we talked about, there's a 1-year deadline from the date of death to exercise, not to exercise, that Prop 19 requires. You have to move into that property and you have to have filed certain documents with the county assessor's office to protect that property tax base, okay? The earlier you're able to make that decision, the better, not just from a Prop 19 standpoint, but from a trust administration standpoint. Because, even though a child may have a year to make this decision, right? Let's say you're the trustee, you may have 3 other siblings who are chomping at the bit for their inheritance. And this other one is holding up that administration because they're still deciding whether or not they want to move forward. And now the trustee has to deal with a lot of competing interests. And I'll kind of touch on that a little bit in a future slide. But again, the timing of this makes a lot, it's very important. So, and will affect a lot of future early and later decisions, okay? Like I said, early decisions reduce pressure. LLCs may support long-term planning. Like I said, if you are contemplating purchasing a second home, third home, vacation home, investment property, talk to us about potentially forming an LLC before you purchase. I can't tell you how many times people buy these properties and then they reach out to us because they have heard from the grapevine, whether it's a CPA, a friend, another business owner, another investment property owner, or a family member. Hey, you could do LLCs and you can do this type of planning, and it may be too late. Okay, so please contact us before you make that decision. Delays can limit flexibility. Loan options may narrow later. That right of first refusal, perfect example of that, right? If we have that right of first refusal in there, the loan options and who the lender can be is infinitely wider, more liberal, more options, less funds, less fees, less problems, right? But if that isn't in there and there aren't other assets to satisfy those other kids, you may have to get a loan at the trust level, okay? And again, I know I'm jumping around here because there's so much information. I'm gonna go back to my very beginning. Remember that there's a cap too, right? So even if you get the loan at the trust level, or even if you get a right of first refusal, but the property's worth $3 million, we have to just understand and know that there's going to be minimal protection. That maybe we only protect 33% of the property, or 50%, or 70%. Okay. And to make matters even more difficult, what if you've named people in the trust who are not children? Okay, what if you have two children and you've named them 40% and 40%, and you've got a nephew who you've named 20%, right? How does that affect all of this Prop 19 planning? Now that you have an individual where if he or she received any portion of that property, it would be reassessed as to that 20%, okay? So talking to the estate planning attorney about that, and potentially the business attorney if it's a non-primary residence, and we can walk you through what that looks like, how to plan for that, and what the best option and for you currently and for your family members ultimately when they receive their inheritance. Okay. Deadlines influence tax treatment. Absolutely. Missed filings create complications. Occupancy, timing matters, and early clarity supports smoother administration. So this is a prime example. The deadlines and the missed filing create complications. So that 1 year deadline, you have to move in and you have to file certain forms with the assessor. If you do not do that, if it's a day late, whether the move-in's a day late, or the filing of those forms are a day late, the property is getting reassessed. Okay, 100% reassessment. Now, it does not mean you are SOL. Okay, you still have the ability to file for what's called prospective relief, and you can file for that relief with the county assessor, and ultimately you may still qualify for Prop 19. But the problem is the time it takes for them to process those forms and then to update the tax roll within the county records may take another year, potentially, depending on when it occurred, a year and a half. And you're going to get reassessed for that first year and potentially that next second or second and a half year. And there's no refund on that. So you're paying full 100% current fair market value property taxes, which it could have gone from $3,000 a year to $12,000 a year. You're paying that for the first year, potentially the second year, and maybe even a partial portion of the next following year. Excuse me. And then they'll revert it back to the initial tax base. So you can still, like I said, you can still qualify, but maybe you had to pay 25,000, 30,000, 15,000 to the assessor that was otherwise avoidable. Okay, so it's important. Timing is very important on these decisions. Having the discussion, understanding these deadlines can create a lot of clarity, right? As you advance through your life and as you move into the final stages, having the discussion with your, for me, having the discussion in my, I only have a son, but hypothetically, if I had a daughter as well, in that instance, having the discussions with them, advising them and talking to them and saying, hey, there's some requirements here. You should probably meet with an attorney for your own estate plan. You should probably have conversations with each other about what your plans are. And that can help clear up a lot of post-death stress, tension, and anxiety between the beneficiaries, or potentially between the trustee and the beneficiary, and so on. Okay. Family alignment, right? Kind of exactly what I just said. Share timelines, reduce conflict, clear expectations, avoid surprises. Timing affects sibling decisions, and planning supports long-term goals. A great example, my daughter and my son. My son wants cash, my daughter wants the property. Okay. What if I named my own brother as the trustee when I pass away? Okay, so my brother is administering this for my children. And and my brother has no other interest in my trust. He's purely just the trustee, just to handle the administration and ultimately distribute the assets and conclude the trust administration. Okay. Now, what if my daughter and my son have been cooperating and they are in alignment, but something happens in my brother's life where he or his spouse or his kids have a medical emergency? And what if he doesn't have access to liquidity and he needs funds quickly? And I have my daughter over here kind of dragging her feet on either deciding on whether to move in, deciding on whether she can go qualify for a loan, or whether she will qualify, and whether she's going to sell her home to fund potential purchase or a potential exercise of right of first refusal. And he needs cash quickly. And what if he doesn't have great credit history? He's not able to get a personal loan, or a personal loan is not desirable, or he needs, cash quick, and he's starting to hound my brother, who's the trustee, for distributions. And that period, we're now in the 8th, 9th, 10th, 11th, month of that administration post-death, and that can create a lot of conflict, right? Because then the trustee is now having to deal with two adverse positions, and as a trustee, he has to treat both of them equally, right? He can't treat one over the other, and he has to make decisions that are for the benefit of the trust and for the benefit of both of these beneficiaries, and that can become quite difficult. So making sure you're talking about, making sure the trustee is having the appropriate conversations with the beneficiaries and the appropriate conversations with the attorney so that they can do their best to negate some of this conflict. They can't eliminate it 100%, but we sure can eliminate a lot of it. And again, the more conflict we can negate, attempt to negate, there are just individuals that are insufferable that you just can't deal with. And I'm sure some of you have family members that are like that. That is life, right? So there's no guarantees that either you or us can avoid conflict, but we can minimize it. We can negate a lot of it. And when that happens, we're able to save relationships. And ultimately, that's the most important aspect of all of this. I can't tell you how many times we've been able to save a relationship, and I can't tell you how many times relationships have been destroyed. And these relationships become so much more fragile during these times because they've lost a parent, a grandparent, a sibling, a child, a spouse, whoever it is. These are heightened moments where our emotions, our subjectivity, are the mainstay in our thoughts, in our mental process and emotional regulation, rather than our objective logical mind. So being able to plan for this and discuss these things really goes a long way into saving relationships, and also just planning for the plethora of different family dynamics that I have, that you have, that all of us may have. Okay, family decisions, emotion and fairness. Homes carry deep family meaning. Memories influence inheritance decisions. Emotional attachment varies by sibling. Sentiment can impact practical choices, and structure helps create clarity. So I kind of went through all of that in the last slide, but sometimes the home may be extremely important to one of your children, whereas the home is not as important to the other. Right? The sentimental value of that piece of property, that thing, that stuff, they may be attached to, and they may be attached to it because it's you, right? By being there, or by touching it, or by feeling it, they are staying close to you. They can relive the good memories that they had with you, and being able to plan for that is huge. I can't tell you how many times I've had trusts at this firm and the other firms I've worked at where there was no planning and, at post Prop 19, the property had to sell, right? Or the assets had to be sold or they had to be liquidated or this or that. And that can have an emotional effect on your family members. So it's very important. Have these discussions. Again, we can't satisfy everybody. A lot of times you have 4 or 5 kids, they all have competing interests. They all have their own spouses and their own friends and their own advisors in their ears. And a lot of times things can get very tricky and complicated because of that. But we can do a lot. We can do a lot to put you at peace, and we can do a lot to try to help maintain the family dynamics and help maintain and keep these sentiments and these cherished memories to the best of our ability. Like I said, sometimes it's just not feasible, but there are a lot of times I've seen fall through the crack where it was feasible, and it's important that we try to flesh those out. Okay. Different goals. Same thing. One child may want the home, others may prefer liquidity. Financial ability shapes feasibility. Can this person go get financing? Do they have the assets to sell to get the financing? Does anybody have the ability to co-sign a loan at the trust level? All of these are being affected, right? Is it even worth it, right? Is the property now worth too much to even contemplate Prop 19, protection, right? But we still want to plan for it, right? We still want to put the right of first refusal. We still want to do these things so that the planning is done appropriately, and then ultimately it's your children who are the ones who are deciding, okay, my mom and dad did exactly what they were supposed to. They gave us the most protection, the most flexibility, the most affordability, and the most clear guidance. And for unknown reason, in my example, the property is appreciated too much, right? Which is also a good thing. The property is appreciated too much, and the current exemption thresholds that the state of California have are too low. It's going to be reassessed too much. We are now making the decision to sell, but it's our autonomic decision, right? As opposed to, California laws forcing me to do this, which is much different, right? Feeling backed into a corner is much different than having control over the decision and feeling that you are the one or your family is the one who's collaboratively making this decision. Okay. And again, clear discussions reduce misunderstanding. Again, we can't avoid or negate all conflict, but we sure can eliminate and or minimize a significant amount of it. Fair process, right? Fairness does not mean equality. Okay. And again, that's because the trustee has to look at the competing interests. It could be that you have one child who has done financially very well for themselves and another child who has not. And then the tension of that, if you leave a property to this person and don't leave offsetting property to this person, that causes all kind of friction. So having those discussions, fleshing out what the pros and cons, what the early and long-term ramifications are, and what tools you can use to communicate that to your family. Very useful, very effective. Buyout discussions require structure. They absolutely do. I've had people come to us. I've had clients who already have administration attorneys, and they've already gone through most of the administration, and they've already done the buyout. And then they talk to a friend or family member who told them to come schedule a meeting with us, and we have a discussion. And I go, it's too late. You went and got a personal loan. You buy it off your sibling. The assessor's going to see that as a sibling to sibling transfer. You're going to get partially reassessed, and you can't fight it. I mean, you can fight it, but it's a losing fight. You will put a bunch of time, expense, and stress into a losing endeavor. Okay, so these structures require a lot of input and a lot of granular level detailed analysis on how to go about it and what the costs are going to be when you go get the financing to do this, and whether or not who's getting the financing. Is it the trustee on behalf of the trust? Is it a sibling? Is it the person exercising a right of first refusal, or is it some other individual? And all of those have different components and different short and long-term effects on each individual beneficiary. Roles and expectations must be defined. Again, this is one of the main reasons of having a trust as opposed to letting your estate go through probate, right? The trust defines a lot of the roles: who has the responsibility, who has the liability, who has the right to purchase it, who doesn't. Are there multiple people who have rights of first refusal, right? This person goes first, then this child, and if none of them exercise, here are the instructions for what to do next, okay? By doing that, it creates clear, defined rules on who has to do what, who is entitled to what, and what the process is, okay? Ultimately, transparency builds trust among siblings. I think it was James Kosarev who does a great example that I steal quite a bit, is when you're watching a whole bunch of children play soccer on a soccer field, it is chaotic, even with the referees there, right? And if we plug the referee, we take them out of the equation, what ensues? Pure chaos, right? We have 20, 22, 5-year-olds running around doing who knows what, right? And that kind of happens when your parents pass away. The referees are no longer there. And even more so, like I said, the grieving comes in, and all these other people and their own personal families are now getting into their ear, and that can cause friction, cause tension, cause problems. So transparency, communication between the siblings, and proper planning by the parents, clearly defining these roles and expectations, helps keep these relationships intact, and hopefully after the loss of the loved one brings them even closer. Maybe it helps with the reconciliation. Maybe they already had a good relationship and now they're even closer afterwards. That is best case scenario. I hope that for my own self, because I have one brother, I hope it brings us even closer together and that we're able to work collaboratively in that endeavor when the time comes. And planning preserves family relationships, kind of like what I just said. A lot can be done to help assist with that. Okay, trustee roles, right? Trustees must act impartially. That can become very difficult if the trust document itself is vague or doesn't lay out enough specific directives on what to do. Or if sometimes it gives a trustee too much lateral decision. And what if one of those children is the trustee? Right now you have resentment being built from the other beneficiaries who are not trustees. Okay. So understanding the trustee's role, understanding all the trustee's fiduciary duties, having a trust document that appropriately gives clear and concise directions to that trustee helps minimize and eliminate quite a bit of the tension and stress during this very difficult time. You've lost a loved one, and all of a sudden you have all these legal deadlines, and all of a sudden you have to go file all these notices, marshal these assets, deal with 5 or 6, 7 different types of taxes, deal with the attorneys, deal with the CPAs, right? There's so many moving parts to an estate administration, regardless of how big or small your estate is, whether you're in probate or not in probate, all of these things are still happening and going on. And having clear, defined guidelines, having a right of first refusal, specifically state child one gets the right of first refusal. If they don't execute it, child two gets it. If he or she doesn't execute it, here's what the trustee should do, or here are the powers and options that they have, or vice versa. You came to us and you formed the LLC and you then bought the investment property, and you're working with our advanced planning and our estate planning attorneys to talk about how to transfer the interest during your life and afterlife to plan for all these different taxes. All of this just helps the trustee. It helps the trustee act impartially. It helps them fulfill their role. It helps them fulfill their duties, and it helps them do so expeditiously. It helps turn a 3-year administration into maybe a 9-month administration, and all of a sudden you're over delivering, and the family members are happy, and the family relationships are preserved and strengthened, and so on. Okay. So again, decisions will affect all beneficiaries, duties extend beyond intentions, and the process matters as much as the outcomes. Practical management. Okay, property management requires organization. Communication reduces misunderstandings, and documentation supports accountability. Timing decisions add complexity. So we've gone through quite a bit of these. Probably going to skip this slide just because we've discussed quite a few of these particulars. Not really necessary. Balancing logistics and emotions. I'm going to keep hammering this, and I'm going to keep hammering this in every type of guardianship, conservatorship, trust administration, probate administration, all of it. The logistics and the objective requirements and the legal requirements will almost always conflict with the emotions and the subjective beliefs. Okay. And melding those and trying to find a way to smoothly cooperate and navigate those conflicting ideals is tough. It's very hard. I will say that every trustee goes through this, is not something you can avoid, but again, something we can minimize if proper planning is put in place. Okay. Managing competing expectations. I talked about my son and my daughter in that example. They had competing expectations, right? One wants this, one wants the cash, one wants the house. One needs cash quicker because of a family emergency. Maybe my daughter doesn't need money that quickly. Maybe she has done well for herself financially, has saved a lot of money, has a lot of retirement, has a lot of income sources. And maybe she's going, look, I can kind of stroll and take my time on this 1 year deadline because I don't truly need it. And maybe they have a good relationship, maybe they don't. Maybe she's empathetic to his needs, and she's willing to cooperate, but maybe she's not. Or maybe she's distance challenged, and because they're in New York and California, maybe there's a less of a connection, less empathy, less sympathy, because they're not in each other's physical lives. Okay, so understanding this helps negate a lot of these future issues. And again, structure helps guide these decisions, understanding the rules, and also not only the structure, but understanding Prop 19, understanding its limitations, right? You can do all of this planning with understanding that if your property appreciates too much, right, it may not be that useful. However, that doesn't mean it's not useful for a whole bunch of other items, right? Let's say you put this right of first refusal in, and the property went from $500,000 when you purchased it, and when you pass away, it's now worth 3.5 million, right? There's going to be property tax reassessment, assuming that Prop 19 is still current law at that time, of course. But maybe the right of first refusal helps with the family dynamic of who actually has the ability to buy the property from the trust. What if both siblings want the property and they both don't want to go on title together, right? They don't want to be on title to this property because you can always do that. We can distribute the property and you be 50% over and you be 50% over. But there's a whole host of issues that come with co-ownership of real estate, right? You're essentially going to business with your sibling. And if you don't have the operating agreement or bylaws or some type of tenancy and common agreement setting forth the rules of engagement, that can get very sticky and will most assuredly end up in a lawsuit against each other. Okay, so I try to avoid that when possible. What if they both want it and they both don't want to be on title with each other? And that right of first refusal can come in handy because they can say, hey, child A, you have the first right to buy it from the trust. And we are putting that in there, and we're putting that in there for a specific purpose. You live in California, the property's in California, my other child's in New York. If they want to move to California, they can, but their right is subservient to the one in California for these purposes. And I can also now, depending on the circumstances, again, talk with us before you divulge this information, but maybe it's important to have that conversation with your children to say, hey, this is not out of lack of love or lack of affection. It's just because of geographically where you are and the short and long-term desires and goals for your individual families. Okay. And clarity supports a smoother administration. I think that goes hand in hand with kind of the items that we discussed here. Property economics. So and I apologize here. I always go on my webinars usually end up going on for way longer than they should, but I just have so much information to give. So some of these I'm going to kind of go through quickly here because they're commonsensical and they less deal with Prop 19. They more deal with, hey, if you are getting this property, you have to be aware of these things, right? There are ongoing costs to property. Property taxes may increase, whether that's a partial increasement or full reassessment. Insurance and maintenance continue. As you know, insurers are fleeing California, so understanding that insurance process and changing title to the insurance once it's been inherited, understanding the pros and cons and the ramifications of that, things to understand, utilities, common sense, and that cost will affect the long-term decisions. Of course, if the property is getting reassessed and you're turning it into investment property, you're going to have to think about that when you're deciding whether or not you want to maintain that property, whether you want to increase rent, so on and so forth. Real estate affects overall financial plans. Cash flow influences keep or sell choices, right? What other assets exist, right? What if the trust has $1 million in cash and they have this piece of real estate? That can help quite a bit because now you have the flexibility. Maybe you don't even need a loan at all. right? Maybe I have a $2 million estate. I got $1 million cash. I got $1 million in real estate, and my son wants the cash. My daughter wants the property. $1 million each, no loan necessary, full protection from property taxes, right? So understanding the the balance sheet of the estate, what income, what debts, what expenses, what obligations, what other assets are existing in the trust, and so on. Holding property changes priorities, selling impacts future goals, timing shapes financial outcomes. And again, we've somewhat discussed all of those things in greater detail in prior slides. Shared ownership complicates planning. We talked about that co-ownership. And for Prop 19 purposes, let's say there's one primary residence. Technically, even if I distribute it to both of my children, only one has to reside there. So you can do that, and that is an option. And there are instances where that is a appropriate dynamic, and it is a viable option. But having that discussion with your estate planning attorney and discussing that with your children is imperative to understand the intricacies of that and to negate some in-sibling fighting if that ultimately ends up being the case. I also have times where multiple children end up living in the property because they've already been doing so. So again, I don't want to say that co-ownership is terrible. There are times when it is appropriate. Having that discussion with us and what qualification under Prop 19 looks like in those instances. But again, just remember, only one child has to reside there at a time under current law, okay? Expenses can create family pressure. Different beneficiaries face different impacts. Clear understanding reduces surprises, and awareness supports informed decisions. We fleshed out a lot of those, so I won't rehash those. So in conclusion, right, there are a lot of different options. There's a lot of different avenues. There are a lot of different intricacies depending on your family, your circumstances, your financial portfolio, what your long-term planning and needs are for your own care and support, what your children's long-term plans for care and support are for themselves, for their family, what they're living, where they're living, what they plan on doing as far as moving a potentially Prop 19 qualification. A lot of this can be fleshed out. A lot of this can be negated, and a lot of planning can ensure a smoother transition of your estate to your loved ones. And that just means that you're able to maintain your legacy, right? And that's what a lot of estate planning is. Some people don't see it that way. Some people kind of see it of, okay, I'm just giving my assets to my heirs. But a lot of times there are a lot of people who say, look, this is the legacy I've created during my life, and I want to keep it. And I want my children to benefit it. And I maybe want my grandchildren to potentially benefit, and my great-grandchildren, right? So these are things that can be delved into in much greater detail and planned for, and a lot can be accomplished if done timely and prudently, right? And ultimately, I always harp on this too, from a financial standpoint. Proactive planning saves costs in every instance. I think everyone understands that concept, but putting that concept into fruition, putting that into practice is a different, separate action item. So learn strategies to protect. Again, just call us, right of first refusal, LLCs, certain trust terms, talking about qualification, talking about timing, talking about the competing interests. All of these things can help clarity, support, and help with your planning as you progress through your life. Okay, lastly, just some kind of basic information here. As you know, if you've done a webinar with myself or any of the other attorneys here, some particulars about our firm. We've been open for almost 5 decades now. We have additional attorneys, more full-time attorneys, more combined experience, more advanced degrees, numerous individuals who are certified specialists, additional highly qualified staff, numerous locations, and always the ability to meet with you via Zoom, phone, email, if not in person. Okay. So thank you for joining us today. Hopefully I was able to give you some overarching understanding of Prop 19, what Prop 58 was, the changes into Prop 19, the current Prop 19 environment, some things that you can do to plan around Prop 19, things you can do to just help your family and your plan under any circumstances. I appreciate all of you for joining with me today. If you have any questions, please email us. Tangentially, please fill out the digital evaluation. If you have questions, our marketing department will go through each and every one of those digital evaluations and reach out to you if you have more questions or you need to have a consultation with the estate planning attorney, and then that estate planning attorney one turns into a meeting with the business department. Whatever it is, put your questions in the digital evaluation, put them in the Q&A. Also, please give me positive, negative, constructive feedback. I welcome it all. Anything I can do to improve my delivery, the information I'm providing, the retention on your end, being clearer, giving better explanation, giving more wholesome explanation, whatever I can do to improve the next webinar. I welcome it all. Or if you want to just give me a little, hey, Mark, love you, you did great. I welcome that as well. Otherwise, appreciate all of you attending this. Thank you again. Hopefully you took some benefit out of this. And please feel free, reach out to us. We're always here to help. The more proactive you can be, the better. Again, email us, fill out that digital evaluation, and we look forward to hearing and seeing from you. Otherwise, have a blessed remainder of your day. Have a blessed remainder of your week. I hope you and your loved ones are doing the best you possibly can. Okay, so you take care. Have a good one. Thanks for joining us again.